So first of all, let's start with the functions of capital. In previous chapters, we learned the major areas of risk a financial institution's manager is facing. This risk arises from both on and off balance sheet activities and also arises from both domestic and international sources. To ensure that a financial institution survives, the manager needs to protect the institution against the risk of insolvency. And the primary means of protecting against this risk of insolvency is having adequate capital. So the first function of capital is to absorb unanticipated losses with enough margin to inspire confidence and enable the financial institution to continue as a going concern. In addition, the capital also protects non-equity liability holders against losses, and that leads to the second function of capital is to protect uninsured depositors, bondholders, and creditors in the case that a financial institution becomes insolvent and is liquidated. Thirdly, financial institutions' capital also protects the financial institutions' insurance funds and taxpayers. How is that? Well, when financial institutions fail, regulators are often required to intervene to ensure the protection of depositors and other creditors. Sometimes this insurance is implicit and sometimes it is explicit. The capital of financial institutions offers a protection to any deposit insurance or guarantee scheme and ultimately to taxpayers who bear the cost of regulators' intervention through deposit guarantees. Fourthly, capital also protects financial institutions' owners against increase in insurance premium. Well, if financial institutions fail, it is likely to cost taxpayers either directly through taxpayers funding the regulator of depositor protection or through funding of government deposit insurance schemes. By holding capital and reducing the risk of insolvency, and financial institution protects taxpayers against a significant calls on taxes. And if there is a deposit insurer or guarantor from the large insurance premiums or cost of funding. So when there is implicit insurance, higher capital reduces the financial institution's risk and thereby cost of fund. And lastly, financial institutions' capital is an important source of financing. In particular, subject to regulatory constraints, financial institutions have a choice between debt and equity to finance new projects and business expansion. Thus, the traditional factors that affect a business firm's choice of a capital structure, for instance, the tax deductibility of the interest on debt or the private cost of failure or insolvency, also impacts financial institutions' capital decision. This leads to the fifth function, to fund the real investments necessary to provide financial services. Well, once we understand the functions of capital, let's see what do we actually mean by capital. The economist's definition of a financial institution's capital or owner's equity stake in a financial institution is the difference between the market values, I repeat, the market values of assets and liabilities. And this is called the net worth of a financial institutions. While this is the economic meaning of capital, regulators have found it necessary to adopt definitions of capital that depart by a greater or less degree from economic net worth. The concept of a financial institution's economic net worth is really a market value accounting concept. With the exception of the investment banking industry, regulators, however, define capital and required leverage ratios are mostly based on book value accounting concepts, which can be misleading. First of all, to see how economic net worth or equity insulates and financial institutions against risk, consider this example, where we have a market value balance sheet that shows the market value of assets and liabilities of financial institutions. And on the basis of market values, we can see that a financial institution has total asset of $100 and the total liabilities and equity of $100 as well. And its net worth is $10. It means that $100 assets are available to pay out $90 liabilities. So the financial institution is economically solvent and would impose no failure costs on depositors or regulators if it were liquidated today. Now, let's consider an impact of a credit risk on this financial institution. Now, as we have seen that the financial institution has a 20 million long-term loan. You can remember this 20 million long-term loan. And then let's suppose that due to a recession, a number of the financial institutions' borrowers experience cash flow problems and are unable to make their promised loan repayments on schedule. A decline in the current and expected future cash flows on loans lowers the market value of the financial institution loan portfolio below $20. Suppose the loans are really worth only $8. This means that the market value of the loan portfolio has fallen from $20, you can see, $20 to $8. Now, the loss of this $12 in the market value of loans appears on the liability side of the balance sheet as a loss of the $12 to the financial institution's net worth. As a result, the financial institution net worth was $10, which is now reduced down to negative $2. Okay, so you can see that owner's net worth stake has been completely wiped out, making this net worth negative. Now, one point we need to understand that with this, the risk involved, the liquidity holders are hurt. However, they do not hurt much. Specifically, the first $10 of the $12 loss in the value of loan portfolio is borne by equity holder, because you can see that equity net worth was $10. Now it is completely wiped out and the net worth become $2 negative. So the $10 is borne by the equity holder. Now this $2 will actually be borne by the liability holders or the depositors. It means that the financial institution has only $88 to pay out $90 to the depositors. It means that if, as the company becomes insolvent and it goes into liquidation, $88 will be used to pay out $90 to depositor. This means that each depositor will receive 97.77 cents per $1. Okay, so this example clearly demonstrates the concept of net worth and capital acting as an insurance fund protecting liability holders, such as depositors. The larger the financial institution's net worth relative to the size of its assets, the more insolvency protection or insurance there is for liability holders and any liability insurer or guarantors. This is why regulators use capital measures such as the ratio of net worth to assets in assessing the insolvency risk exposure of financial institutions. Now, market value, the capital, also has a relationship with the interest rate risk, because as we have previously learned that the value of assets and liabilities both adversely affected by the changes in interest rate. So as a financial institution follows the market value, the convention of capital, it also needs to be aware of the effect of interest rate changes on the market value of assets and liabilities. Now, book value of capital. So book value of capital and capital rules based on book values are most commonly used by financial institutions regulators. Now, if we look at this example here, we use the same initial balance sheet that we have previously seen, but now we assume that the assets and liabilities are valued at their historical or book values. Okay, so the $80 long-term securities, I'm talking about this one, $80 long-term securities and $20 long-term loan reflects the original book values of those assets. That is, they reflect the values at the time when the loans were made and the bonds were purchased, which may have been many years ago. Similarly, on the liability side, the $90 in liabilities reflects their historical cost, and the equity value shown in the now book value of the shareholders' claims rather than the market value of these claims. For example, the book value of capital, the difference between the book value of assets and liability usually comprises 4 components. And this is what I'm talking about: par value of shares, surplus value of shares, retained earnings, and loan loss reserves. So par value of share is the face value of the ordinary shares issued by financial institutions. Surplus value of shares, on the other hand, is the difference between the price of public paid for common stock or shares when originally offered and their par values times the number of shares outstanding. Retained earnings is the accumulated profit that retained with the firm for future investment. Loan loss reserve, a special reserve that set aside out of retained earnings to meet expected and actual losses on the portfolio. Now, suppose that some of those who borrowed $20 that have been shown in this balance sheet, loans are having difficulty keeping to repayment schedule. We assumed in our previous example that the revaluation of cash flow leads to an immediate downward adjustment of the loan portfolio, the market value from $20 to $8, a market value loss of $12. But by contrast, under historical book value accounting methods, financial institutions have greater discretion in reflecting or timing problem loan loss recognition on their balance sheets, and thus timing the impact of such losses on capital. The market value balance sheet is reflected in our previous example, which was negative $2, if you can remember. So we come back to this book value accounting. However, unless there is some loan loss charges, this would be no impact on the book value balance sheet that we see in this screen. Indeed, financial institution may well resist writing down the values of bad assets for as long as possible to try to present more favorable picture of the financial performance to depositors and regulators. Such resistance may be expected if managers believe that their job could be threatened when they recognize such losses. And only the pressure from regulators may force loss recognition and write down in the value of the problem assets. Suppose that in this example, the historical book value accounting of the financial institutions, the financial institution is forced to recognize a loss of only $3 instead of $12 on the loan portfolio. And this $3 is a charge against the $10 of the shareholders' book value. So technically the $3 loss on asset would be charged off against the loan loss reserve component of the equity. So you can see that the equity loss is only $7, so it's still positive, and the financial institution is still in a solvent position. Okay, so this is how actually the book value and the market value accounting differs in terms of how they are presented in the balance sheet. These points I just discussed that financial institution tends to differ the write-down of the bad loans. Now, in practice, with large publicly traded financial institutions, we can get a good idea of discrepancy between book value and market value of equity, even when the financial institutions itself does not mark its balance sheet to market. Specifically, in an efficient capital market, investors can value the shares of a financial institution by doing an as-if market value calculation of assets and liabilities of the financial institution. This valuation is based on the financial institution's current and expected future net earnings or the dividend flows. The share price of the financial institution reflects this valuation, and thus the market value of its share outstanding. So the market value of equity per share is the market value of equity ownership outstanding divided by number of share. Book value of share, on the other hand, is par value of equity plus surplus value plus retained earning plus loan loss reserves that I have shown in this slide, divided by the number of shares. The ratio, the market to book value, is often called market to book value ratio, and shows the degree of discrepancy between the market value of a financial institution's equity capital as perceived by investors in the stock market and the book value of capital on its balance sheet. The lower this ratio, the more the book value of capital overstates the true equity or economic net worth position of financial institutions as perceived by investors in the capital market. Now, arguments against market value accounting. While the discussion so far suggests that market value accounting is superior to book value accounting, there are arguments against its use. The first is that market value accounting is difficult to implement. This may be especially true for small banks, building societies, and credit unions with large amounts of non-traded assets such as small loans in their balance sheet. When it is impossible to determine accurate market prices or value of assets, marking to market is likely to be fraught with error. A counter argument to this is that the error resulting from the use of market valuation of non-traded assets is still likely to be less than that resulting from an use of original book or historical valuation, since the market value approach does not require all assets and liabilities to be traded. As long as current and expected cash flows of an asset or liability and an appropriate discount rate can be specified, approximate market values can always be imputed. The second argument against market value accounting is that it introduces an unnecessary degree of variability into financial institutions' earnings and thus net worth, because the paper capital gains and losses on assets are passed through the financial institution's income statements. Critics argue that reporting unrealized capital gains and losses distorts income if the financial institution plans to hold these assets to maturity, as such, never actually realize capital gains and losses. Further, some regulators argue that they may be forced to close banks too early, especially if an interest rate spike is only temporary and capital losses on securities can be quickly turned into capital gains as rates fall again. The counter argument is that financial institutions are increasingly selling securities assets rather than holding them to maturity. Further, the failure to reflect capital gains and losses from interest rate changes means that the financial institution's equity position fails to reflect its true interest rate risk exposure. The third and the final argument against market value accounting is that financial institutions are less willing to accept lower term asset exposures, such as commercial mortgages and business loans, if these assets have to be continuously marked to market to reflect changing credit quality and interest rate. For example, we have learned in Chapter 5, long-term assets are more interest rate sensitive than short-term assets. The concern is that market value accounting may interfere with the financial institution's functions as lenders and monitors and may even result in a major credit crunch. So this is the end of our discussion on functions of capitals, book value and market value accounting of capital measurement. So in the next videos, we will discuss capital measurement and capital adequacy requirement. Thank you very much.